for joining us. Although I think being indoors in air conditioning, hopefully you all are, is probably better than being outside today and through this weekend when it's just going to be incredibly interesting. So the first thing we have to do is go through a little disclosure. I am a CPA, but I may not be your CPA. So in anything that comes up in this webinar, please either ask me if I'm your CPA or ask your CPA before you implement any of these strategies. They're pretty complex, and you would want to make sure that you're doing the right thing and remembering all the right advice. So today's agenda looks like this. We're first going to do understanding legislation, marginal taxes, what that is and how it works, interactions between income types, strategies to reduce your lifetime taxes, and then next steps. My goal today is for, wait a second, my screen just jumped. My goal today is for you to leave here with a little better understanding of how taxes are different in retirement than what they may have been before you retired. Just a little bit better understanding. And so hopefully you'll avoid some of those really common but can be very costly pitfalls that come along. Of course, we do want to stick with the actionable. So if you have questions, please stay away from the political. Let's stick to what is. And hopefully that sounds good to everybody. I know it does to me. And then one more note is that all the charts that we're going to talk about are going to be married filing joint, because that's usually who attends these webinars. But if you're single or head of household, the principles stay the same, but some of the threshold numbers change. So if you're in that situation, just let me know and we can talk about it hopefully at a meeting in the near future. So parent filing joint tax bracket. So in theory, it's straightforward and extremely similar to the old tax system before tax reform. Tax reform was the 2017 reform that took place in 2018. The new brackets have lower rates at each step, which is why most people will pay less under the new tax system than they did under the old system. This structure is specifically for ordinary income. Now, ordinary income is wages, self-employment income, interest income, annuity and pension income, so and IRA withdrawals. So you can see that as your income goes up, the tax rate also goes up. So I can't really see your hands, but if this were a seminar, I could. But just to ask yourself, if you have ever filled out a paper tax return, I know I have hundreds of them, but I've been doing taxes for 42 years, and those first 5 years were primarily all in paper. So you've probably seen a more complete version like this of the tax brackets than the one that was on the prior screen, with the base amount and then the rate above that amount. When people fill out a paper form, this representation makes it much easier to realize that only the income that falls into a given bracket is taxed at that bracket. So what this is really saying is that if your income is 0 to 19,900, all of it's going to be taxed at 10%, your taxable income. And we'll talk about the difference between total income and taxable income in a moment. But if you have dollars that fall over 19,901, but below 81,050, then you would pay the tax 10% of 19,900 plus 12% of the amount that's over that. And as your income goes up, so do the brackets. So you can see that at this point it would be 19,900, but if you maxed out your 10% bracket and your 12% bracket, then your base tax would be 9,328 and 22% of the amount over 81,051. This might be an easier way to visualize those tax brackets. Charts usually are just easier than strictly numbers. We call it the tax map because it illustrates the rate at which each additional dollar is going to get taxed at. In retirement, two of the most common sources of ordinary income or pension income and withdrawals from IRAs. Notice that from 0 to 27,800, which you really can't see because that's off their chart, that there is no tax. So this basically starts at 27,800 is where taxes start. The 27,800 is the new larger standard deduction plus $1,350 for each person in a married filing joint return that's over 65 or blind. From the above 27,800 to just over 47,700, income will fall in that 10% bracket. Only that income falls in that range gets the 10% rate. For the income that falls between 47,000 and 108,850, that's going to get taxed at this 12% rate. In those ranges look odd to you, it's because we've included the new standard deduction for married couples. We'll discuss that later. There are two spots on this map that are really worth paying attention to because of the really large jump. So we go from 10% to 12%, a 2% jump, not a huge difference. But we go from 12% to 22%. That's a really big difference. 22 to 24, once again, 2% isn't going to get everybody excited, but 24 to 32, an 8% jump, that is, once again, a really big jump. And why that's important is because this is where we can do the most planning and save the most taxes by doing that planning. So we're going to talk about marginal tax rates. We've just hit on that concept. The concept of a marginal tax rate, your marginal tax rate is the rate you pay on your last dollar of income. So that becomes more important when we talk later on. Now we defined ordinary income as wages, self-employment income, interest, IRA withdrawals, pensions. So capital gains income is money that you've invested or in something. So whether it's real property or stocks or bonds, the public policy goal is different for capital gains and qualified dividends. Capital gains and qualified dividends get their own tax brackets that are separate from ordinary income. These brackets are lower primarily to meet the public policy goal of encouraging people to invest in the economy. There is still a marginal tax concept for capital gains and qualified dividends, but the brackets are considerably different. Here's a question: at what rate are capital gains taxed? So you can see that from 0 to 80,800 of total taxable income, the capital gains bracket is 0. So capital gains also has that marginal tax structure. So moving along, notice that the 15% capital gains bracket roughly aligns with the ordinary income bracket, so that long-term capital gains and qualified dividends that would fall into the 10 or 12% ordinary income bracket actually come through as 0 tax rate. The reason this is the old capital gains system was effectively left behind in the new tax bill. We only get to the 15% bracket when it would normally fall into 22% bracket on the ordinary tax system. So you get a tax benefit of 7% by having long-term capital gains if your income's in that area, rather than paying ordinary income tax. The 20% capital gains rate applies where the old 39.6% ordinary income bracket would have begun. So the tax bill didn't dramatically change capital gains opportunities for high income earners. You guessed it, although 15% is the rule of thumb, it does not hold true at all times for what the capital gains rate is. So again, here's the tax map. If you had only dividends and capital gains on your tax return, you would pay 0% until you have enough income to fill the 12% ordinary income bracket. So you would have to have that $81,050, but when it comes on to the minus $250 for the capital gains bracket. The taxpayer in the highest ordinary income bracket of capital gains is here, pays 20 at the highest ordinary income bracket at 500,000, only pays 20% if it's a capital gains. The highest ordinary income bracket is 37%. So you can see that's a 17% benefit for high income, high wealth people. This is really an important concept because it shows how capital gains taxation is actually linked to the ordinary income. Once the combination of capital gains plus ordinary income pushes you above the threshold, your capital gains become taxable at 15%. This structure really didn't change under the last tax bill, but because of the new larger standard deduction, the range at which it impacts you did change. Deductions, exemptions, and credits, which brings us to the changes in deductions, exemptions, and credits. These reduce your federal tax bill, effectively making the first several thousands of dollars into the household tax-free, that $27,000 that we talked about earlier, that's a standard deduction plus the amount for the over 65 or blind. You can think of deductions as reductions in income for certain things you spend money on. You can either track those things such as mortgage interest, investment interest, property taxes, income tax, charitable giving, and fill out the Schedule A itemized deductions, or you can take the new higher standard deduction. Now, when I say higher standard deduction, in 2017, the standard deduction for a married couple was $13,000. Today, the standard deduction for a married couple under age 65 is $25,100. It's commonly estimated that only 15% of the population will itemize. For many retired taxpayers, even before the increase, there simply wasn't enough deduction to warrant itemizing on the Schedule A. So if your house was paid off, you had no mortgage interest, if you lived in certain areas, maybe your property taxes weren't as much. If you weren't charitably inclined, your charitable giving wasn't as much. So you may have been below that 13,000 pre-2018 number anyway, and now you get a number that's over twice that size. Once you reach age 65 or you're blind, you can get an additional deduction of $1,350 for each person in the marriage, or $1,700 for a single person. This provision was retained in the new tax law and actually increased $50 from the 2020 levels. Deductions and exemptions reduce your taxable income, indirectly reducing your tax. Credits, on the other hand, directly reduce your tax bill dollar for dollar. Tax credits are specifically designed to incentivize behavior. Two of the most common tax credits are the healthcare tax credit and the earned income tax credit. A less common one, but one that may be accessed by some people who take a part-time job in retirement, is the Savers Credit, which basically incentivizes low-income people to save for their retirement. Remember, even if you've been a high-income earner all of your life, your tax return may be set up in a way to present you as a low-income earner between the point where you formally retire and the time that you begin taking your required minimum distribution from your IRA account. Here's an example of a couple that has $38,000 of gross income. Now, at least $2,000 of that income must be in the form of wages for this to work. First, we reduce the income by the standard deduction for a married couple, which is the $25,100, plus the additional deduction for being over 65, $1,350 each, for total deductions of $27,800. And then we get to subtract off $2,000 for that IRA contribution that you made because you worked and earned at least $2,000. We come up with a taxable income of $8,200. Now, clearly they are in the 10% bracket. Remember that 10% bracket went way up to $19,900. So 10% of $8,200 is $820, which is their tax. But because they put away $2,000 into their IRA and their low income at this point, they get a $1,000 saver credit, which reduces their $820 tax down to zero. And you may be saying, well, what happened to the other $180? But this is not a refundable credit. This is a credit that you can just use against your tax and get no refund. But it still is a pretty cool way to be able to continue to save into retirement that you wouldn't have, and get a credit that reduces your taxes. So you're really getting the benefit of putting away $2,000 and not paying tax at all. Remember how our tax map showed no tax up to $27,800. That was the impact of the new standard deduction plus the additional deduction for being over 65 and blind. So that's here. Realistically, if that was all there was to the tax system, it would be relatively intuitive and pretty simple to understand and work through. But unfortunately, in retirement, we see several complicating factors. Each of these factors are on the screen, create an environment where what you expect to pay, what you expect to pay may not be what you end up actually paying. We'll dig into this into each section. So we have the required minimum distribution, the amount that you have to take out once you reach the age of 72 or the year that you reach the age of 72. Capital gains, we've seen how you have different tax rates for capital gains and how as your income goes up, those rates go up. Social Security benefits, when do they become taxable and how much becomes taxable? Medicare premiums, and people will say, well, that's insurance, that has nothing to do with taxes, but it does today. Potential Roth conversions, when you convert your IRA into a Roth, you pick up the tax in the year that you make the conversion, but then the Roth will grow 100% tax-free, where an IRA grows 100% taxable. Or in a year when you might take out a large withdrawal from an IRA to do a remodel on your house or to take the family on a really big vacation. Then we have something called the net investment income tax, which is an additional 3.8% tax for higher income people. And then we have the alternative minimum tax, which is a tax system that actually runs parallel to the ordinary income tax system. And we'll see how that works. The first complicating factor is the required minimum distribution. Most of our clients have saved pretty significantly into their 401ks and 403bs or IRAs over the years. Generally, these contributions were pre-tax on the front end, and so all withdrawals come out as ordinary income. You don't get capital gains treatment on things that have gone into an IRA. Once you reach age 72, you are forced to begin taking those withdrawals. The process for calculating these withdrawals is relatively straightforward. Each year, you take the ending balance of your prior year account, right? So your IRA at the end of 12/31/2020, we take that balance and we divide it by a factor representing your remaining life expectancy. So here is the example of the calculation. So if your prior year balance was $500,000 and you're age 72, the government says you're going to live another 25.6 years. And so you divide that out and you would need to take $19,531 as your RMD in 2021 if that's the year you turned 72. And I've always thought it was extremely helpful that the government told us how long we were going to live. So you can just pick your age and see how many years you have left, and what kind of money you have, and know that you can either spend big or maybe cut back. Notice that each year as you age, your life expectancy goes down by less than 1 year. It's not a linear calculation, such that the table runs all the way out to 115 years. And even at 115, you only have to take out a little more than 1/2 of your prior year balance. You say, no big deal. The key here is that if you've done a really good job of saving for your retirement, your minimum distribution plus your Social Security may be more than you actually need to sustain the lifestyle you want to live. If that's the case, it's likely you will be paying more tax on the back end than you could be, as we'll show you in the next few slides. When you think of capital gains, if you're like most people, you'll think 15% tax, but only when I sell something that's appreciated. Not really something to be that concerned about. What many don't realize is that you can recognize capital gains even without selling anything. This is called phantom gains. The best way to illustrate this is with an example. Say mutual fund A bought Apple stock in 1985. You bought into mutual fund A in 2019 and held it all the way through 2021. In the middle of 2021, the fund manager decides that Apple is no longer a good investment anymore and sells the entire position. Any gain that was recognized on the sale must be, by law, passed through the mutual fund to the current shareholders, even if you didn't participate in any of the gain of the underlying stock in all those prior years. The important thing to remember about capital gains is that if you have invested non-qualified money is money that is not in a retirement account, not in a tax sheltered account. If you have invested in non-qualified money, even if you're generally a buy and hold kind of investor, it is likely that you will recognize at least some capital gains in some years. More importantly, when you experience a capital gain on your return, it can have a greater impact than just the tax on the gain because it increases your adjusted gross income and may cause other deductions or exclusions to be phased out and other kinds of income to be taxed. So one of the best examples of a counterintuitive nature of how minimum distributions interact with capital gains to create ordinary income is through the taxation of Social Security. If you had on your tax return, if all you had on your tax return was Social Security, you would pay no tax, no federal tax, no Oregon tax. But when you have other types of income, it can cause your Social Security to be taxable at the federal level. It's common among advisors to say 85% of your benefits are going to be taxed. But that really is only true for high income people. Other people may, and 85% would be taxable and 15% would be tax-free. For middle and upper middle income folk, that is not really true oftentimes because it is based on a formula called the provisional income formula, which can have some really strange impact. Let's walk through how that happens. Your provisional income includes 1/2 of your Social Security, all of your ordinary income, all of your dividends and capital gains, plus non-taxable income. So this would be the money that you put into municipal bonds because you didn't want to pay federal or state income tax. You have to add that money back in to come up with your provisional income for calculating the amount of your Social Security that's going to be taxed. Now, the tax thresholds. Once we have calculated provisional income, it's time to apply thresholds. The key here is that only the provisional income falls over the threshold becomes taxable Social Security. The best way to demonstrate this is with an example, but I want to point out these thresholds. So the first threshold is $25,000, and if you have more than 25,000, say you had 30,000 of provisional income, then 5,000 would be taxed at 50%, none at 34%, because nothing's over that second threshold. Same thing with the married filing joint. So now our example, we'll do two examples, both of which have $60,000 of household income. In the first, we have $20,000 of Social Security and $40,000 of IRA withdrawal, giving us $50,000 of provisional income. Half the Social Security, $10,000, plus the IRA withdrawal, $40,000, gives us the $50,000 provisional income. Then we apply the first threshold. For a married couple, that's $32,000. So you can see that we have $18,000 over that first threshold, and that's going to get taxed at 50 cents for each benefit dollar over the threshold will become taxable. So we have $9,000 of taxable Social Security on the first threshold. Now we apply the second threshold, which is $44,000. You can see that we have $6,000 over that threshold. That's going to be taxed, 35% of that's going to be taxed for $2,100. Now you say the reason it's 35 and not 85 is because we've already picked up the 50 cents over here, making the 50 plus 35 to 85. In other words, even though we have 60,000 of household income, only 55% of it is going to be taxable Social Security. You can see it's not 85 in this case. Now let's look at the other example. We still have 60,000 of total income, but in this case, we have 40,000 of Social Security and 20,000 of IRA distribution. So we have half the Social Security, 20,000, plus 20,000 for the IRA, gives us 40,000 of provisional income. We apply the first threshold, 40,000 versus 32. We have 8,000 that is over that first threshold, 50 cents on the dollar, $4,000 is going to be taxable Social Security. But as you can see, we have nothing over that second threshold of 44,000 because our provisional income was only 40. So we have a taxable Social Security benefit of $4,000, or only 10% of the total Social Security received. When we bring those numbers onto a tax return, we see it is a bit clearer. So 401k, IRA, $20,000, Social Security blend result, $2,398. So the first example, remember, we had taxable Social Security, $11,100, other income, IRA, $40,000, total taxable income, $51,100, minus our standard deduction plus our being over 65, $27,800. We have taxable income of $23,020. It is in the 10 and 12% tax brackets. So total tax, $2,398. Client B, 20,000 of IRA, 40,000 of Social Security, taxable Social Security, 4,000, other income, IRA, 20,000, total taxable income, total income, 24,000, minus our standard deduction plus our being over 65. We have taxable income of 0 and therefore a tax of 0. So now we've covered the most common way, things that create both confusion and opportunity around tax and retirement. These last few are things that impact higher income people primarily, but could impact you in a year when you did a Roth conversion or had a larger or unusual purchase where you took a bigger amount out of your IRA. Medicare is also means tested these days, and these thresholds include your full Social Security benefit, not half. If you fall over the threshold, you end up paying an extra Medicare Part B, and Part D premium. And the scope of your total tax bill is probably not much, but it's not insignificant either. These premiums are based on your income from 2 years ago, so it's worth paying attention to the thresholds as you consider how much to take for various accounts, from various accounts. You can see that if you're under 176,000 of total income, remember all your Social Security plus all your other income, but not the tax-free income, your Part B premium is $1,782 this year, and nothing extra for Part D prescription medications. However, if you have $1 more, that premium jumps up by $700 a year, and you have to pay about $150 for your Part D. So it's all or nothing. It's not, maybe you can have $1 more. No, $1 more and it jumps up the same thing. $1 more here, it jumps up by $900 and $381. So you can see it can become fairly expensive. And when you get down here where you're over 750,000, that Part B has now increased by $5,300, and your Part D has increased by just a little over $900. So we're talking really a $6,000 increase for a higher income couple. Now, the 3.8% net investment income tax also impacts higher income taxpayers, or as we said earlier, in a year when you were to take out a larger amount out of your IRA, or you were to do a larger Roth conversion. It creates an additional 3.8% tax on net investment income. Net investment income includes capital gains and qualified dividends, capital gains and all dividends, interest and annuity payments, passive business income, and rents. So let's go back just a second and talk about what passive business income is, because this does come into play at least a few times a year. So, you know, your son or daughter comes to you and says, Mom, Dad, I want to start a new business and I'm going to need from you about $100,000. You can be a 25% passive owner. As we start distributing out income, we're going to be able to distribute some of that income to you as an owner, and you'll have no legal liability because you're going to be passive. However, when this money gets distributed out, it can drastically affect your total income and may throw you into the net investment income tax position. If that's the case, you might want to say to them instead, hey, I don't want to be an owner, just let's do it this way. We'll loan you the money, we'll put it on a 5-year note, and you don't have to pay us principal or interest until the 5 years. Now you have no income for the first 4 years, and in year 5, you can gift them the amount of the interest, you can gift them the amount of the principal, and not have any income or back income into you. But the thing of it is you don't want to do this being really nice to your kids and wanting to participate in their lives and have it throw you into a higher bracket than you would have been in otherwise, because they're successful and paying you back. Basically, if the income is not derived from work, so that work is wages and work is self-employment, or it's not a return of capital, it doesn't, and it falls over 200,000 or 250 of gross income, those thresholds, it is likely going to be subject to the 3.8% additional tax. So it's not wages, if it's not self-employment income, if it's not paying you back for what you put in, you're probably going to have to consider it for the net investment tax. The final distortion, again, applies for only people who have higher income and a lot of deductions. And that's true, but it also can come into play in some quirky ways for other people. It's called the alternative minimum tax system. It's a flat tax that runs parallel to our normal tax system. Prior to tax reform, it was estimated that fewer than 4 million taxpayers nationally would be subject to the AMT. Tax reform significantly increased the thresholds and phase-outs related to AMT, so it will apply to just a few taxpayers going forward. But if it applies to you, you likely know it, and so you know how to deal with it. But I would definitely say if you're in an AMT situation, you definitely want to get some professional help, because there's ways that you can minimize paying an AMT. There's ways that if you pay an AMT, you can get it back as a credit in future years if you apply it correctly. The complications that we've outlined should highlight one major point. Over time, when the government has needed new tax revenue, the method has not meant to change rates or brackets evenly across all taxpayers. Instead, it has been to introduce phase-outs of deductions or exemptions, or begin to include income that was previously taxed, not taxed, like Social Security. The result is a tax system in which the most important number isn't necessarily the tax bracket you land in, but instead is the effective marginal rate. In other words, how much of your last dollar did you actually lose to federal income tax? Let's revisit the tax map. Remember, as you increase your ordinary income across the bottom, you can see that the rates go up. You can see the rate that you should intuitively be able to apply to your dollars. You know, if you're 100,000, you should be paid 10% tax, 12% tax, and have a small piece in the 22% bracket. And here's the map for the capital gains. Same thing, that's 0 to 80,500. You shouldn't have to pay tax on your capital gains total income. And then it should be bounced up to 15% and then bounced up to 20%. Let's do a quick case study to illustrate the idea of effective marginal rate. We have John and Jane, married, filing jointly, both over 65. They have 61,000 combined Social Security, 10,000 long-term capital gains, and 52,000 of IRA distributions. Here's their tax map. You can see that once they harvested a little over $10,000 of ordinary income, they experienced an 18.6% effective marginal rate. That is the point where their ordinary income plus capital gains drags enough Social Security into the calculation to begin making every additional dollar withdrawn from the IRA taxable at 10%, and each additional dollar dragged in from the ordinary income from the IRA brought in 85 cents of Social Security into the mix and created an effective marginal rate of 18.6%. You can see this couple never really experienced the 10 or 12% brackets. They go from 18.6% to 22.2 to 49.5 before they drop back down to a regular tax bracket of 22%. Now, you say, whoa, wait a minute, that spike occurred in the 12% bracket. How did that happen? And truly, you're not alone. I mean, this is not necessarily really simple. Intuitively, this is a couple in the 12% bracket for ordinary income. You would expect $1,000 from the IRA distribution to create a 12% tax or $120. But here's what actually happened. The $1,000 IRA withdrawal did get taxed at 12% and did create $120 of tax. But it caused $850 of your Social Security to become taxable in the 12% bracket, which caused $102 tax, which then caused $1,850 of capital gains to be taxed at 15%, which triggered a $277.50 tax. So on that $1,000 that was withdrawn, they actually paid $499.50 in tax. You have a very similar effect with capital gains. If a couple, not that couple, but if a couple were choosing whether or not to sell a stock with a $25,000 gain this year, they would certainly want to know that at what portion of that sale they would actually lose the federal income tax. Maybe it would make sense to sell part of the position in one year and part in another to avoid this spike. So when you look out, and this all entails planning. Without question, everything in this program entails planning. But you say, you're in fourth quarter of 2021, and you say, I really want to remodel my kitchen. You have to decide, does it need to happen in 2021 before Christmas and people come over for the holidays, or can it happen in 2022, in which case you could take half the money in 2021 and half in 2022, or maybe you're starting your Social Security in 2022 when you turn 70, so maybe you're better off selling that extra stock in 2021 and not triggering a tax on Social Security, or maybe you're 71 in 2021 and you want to take that money out before you have to take that first RMD in 2022. Once again, planning is the key. The fact that there are a lot of ways to control your taxes and to plan in advance to create tax-efficient retirement. Diversifying among different account types that have different tax treatments, using tax-deferred products where appropriate, blending withdrawals from different account types rather than simply harvesting in sequential order, and paying close attention to which types of investments you hold in which accounts can make a big difference in the tax efficiency of your retirement income. So if you diversify, if you have an IRA and you've done contributed to a Roth or done Roth conversions, so IRA fully taxable at ordinary income rates when you withdraw the money. A Roth, when you withdraw the money from a Roth, zero tax. When you have a taxable account, you're going to have some capital gains if you withdraw and have to sell. So, and some dividends and qualified dividends. So you're going to have some partially taxable dollars. If you have something that's worth $50,000 and you have a basis in it of 30, you sell it, you're going to pay tax on 20,000 of long-term capital gains if you've held it more than a year. When they talk about tax-deferred products, they're talking about annuities. So if you have a large amount of money in the taxable account, and that large amount of money each year is creating dividends, ordinary dividends, qualified dividends, interest income, capital gains income, and you're already a high taxpayer, then maybe you want to use a tax-deferred product like an annuity where you put the money in, you don't get a tax benefit going in if it's not an IRA, if it's a non-qualified annuity, but you don't have to report any income in from that account until you start withdrawing it. So that's the upside. You have a number of years, you don't have to report income. The downside is that when you do take that money out, it's like an IRA in that it's all ordinary income. You don't get capital gains treatment. So that's kind of weighing the difference between capital gains treatment on a year-to-year basis, or losing that capital gains treatment and having it as ordinary income at the end. Blending your withdrawals. Maybe your biggest bucket of money is your IRA, and your smallest bucket is the Roth because you haven't done a lot of conversions. And then you have qualified dollars where you certainly do not want to spend down all of your IRA and then all of your non-qualified dollars and then your Roth dollars. You want to be able to manage and control your taxes by taking some of the money from your IRA, that's going to be 100% tax, some of the money from your Roth that has zero tax, some of your money that's long-term capital gains, so you've got a tax benefit. Properly withdrawing from different accounts, which we just talked about, and then what's in those accounts. So if you have a Roth, you know you're not going to pay tax on those dollars when you pull them out. So if you've got a stock that you expect to go up exponentially, and you expect it to go up, 10, 15, 20% a year, you probably want that stock in your Roth because you don't want to have to pay for that gain. If you've got a municipal bond that is double tax-free, it's not going to get taxed for federal or state, really no point in having that in your IRA, because here you have money that's going into your, coming off that municipal bond every year, going into your IRA that would be tax-free in a non-qualified account. But when you pull it out, you're going to pay tax on it as ordinary income coming out of an IRA. So making sure that what you have in your accounts is appropriate for what's in the accounts. So you're not paying tax on dollars that you wouldn't have had to have paid tax on had it been set up slightly differently. The fact is, these tax maps look completely different depending upon your specific situation. Everybody's tax map is going to look different. You really do need to schedule an appointment with one of us in the office sometime in the next couple of weeks. If you're an existing client, please come in. We'll run through your tax map. I use your tax map when I'm looking at making decisions in your account, but you don't ever see that. So come in, let's talk about your tax map and have it part of your tax planning program. Let's use it as part of our planning that we do for you otherwise. And if you haven't come in and done planning with us, you really need to. If you're not a client, this is a free invitation. Come in, let us help you develop your tax map. We can look at 2 or 3 different scenarios. So maybe looking at withdrawing a bigger IRA distribution or a smaller one, as long as you're meeting your RMD, or if you're less than 72, looking at what a Roth conversion would do to your taxes without taking any IRA distributions. If you're not 70 yet, look at what starting Social Security might do, or how that Roth conversion could affect you before you start taking Social Security. Please come in. It's free of charge. We'll send you home with your own personal tax map. It's well worth the time you spend. After all, we're going to spend our time helping you, so it might be good for you to invest some time in yourself to help yourself. And then I love this quote. It was from Judge Leonard Hand in 1934. Anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays Treasury. There is not even a patriotic duty to increase one's taxes. Really take advantage of the tax laws. Don't abuse them, but take advantage of everything that's there. Now, questions?